Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Apple is known for having a massive cash reserve, currently around $160 billion, which seems like more than enough to cover any expenses or investments. Yet, despite this huge amount of cash, Apple frequently borrows money. This might seem confusing at first, but it's actually a smart strategy rooted in advanced financial management. The company uses borrowing as part of a sophisticated approach to optimize its capital structure, manage taxes, and support ongoing growth and shareholder returns. Today, we'll explore how Apple's financial decisions work behind the scenes and uncover why this major company chooses to borrow money even when it has so much cash on hand. Imagine having more money than you could spend even if you lived for many lifetimes, and yet still deciding to take out a loan. That's exactly what Apple has done for years, holding over $100 billion in cash and marketable securities, while also carrying significant debt and releasing bonds regularly. At first, this approach seems puzzling. Why borrow money when you already have so much? But this strategy is actually a smart example of corporate financial engineering. Apple borrows at low interest rates, keeping its overseas cash invested to earn attractive returns. This method helps Apple optimize its taxes and capital structure, ultimately maximizing value for its shareholders over time. The images here show Apple's iconic logo, highlighting the company behind this financial strategy. When we talk about corporate cash, it's important to understand that it doesn't just sit in one simple bank account. Large companies like Apple manage their cash through multiple subsidiaries across different currencies, countries, and various investment types. Apple's financial resources have traditionally included a mix of cash and equivalents, government securities, corporate bonds, marketable securities, holdings in their international subsidiaries, and strategic liquidity reserves. These reserves give Apple the ability to stay flexible in their operations, continue investing in innovation, secure their supply chain, fund acquisitions, and navigate economic downturns. The exact location of this cash matters a lot because it affects taxes, regulations, and how quickly the money can be accessed when needed. Apple's borrowing strategy revolves around a concept called tax arbitrage. Before the 2017 tax reform, much of Apple's cash was held overseas, and bringing that money back to the US came with hefty tax bills. So Apple faced two choices: either repatriate the overseas cash and pay a large tax charge, or borrow money based on its strong financial position while keeping its overseas funds invested. Since Apple could borrow at low interest rates of around 3 to 4% and earn similar or higher returns by leaving its overseas cash invested, it made financial sense to borrow instead of paying those big taxes. Essentially, Apple wasn't borrowing because it needed cash. It was borrowing because tapping into its own overseas cash would have been more expensive due to taxation. This approach allowed the company to minimize tax costs while still having access to funds at a relatively low cost. Apple's strategy involves several key steps that work together to create real shareholder value. First, the company accumulated a large amount of global cash from strong international profits on products like iPhones, Macs, iPads, as well as services and software. Instead of letting this cash sit idle, they invested the excess liquidity in highly liquid securities, which kept the funds safe while earning steady investment income. At the same time, Apple took advantage of its strong balance sheet to access bond markets, allowing them to borrow money at favorable rates since investors trusted the company's financial strength. The proceeds from these bond sales were then used to buy back shares, pay dividends, and make strategic investments, which helped optimize their overall capital allocation. All the while, Apple carefully managed this process to preserve tax efficiency, minimizing unnecessary tax costs and maintaining an optimal capital structure. By doing this, Apple turned a situation that might seem contradictory, having huge cash reserves while borrowing, into a smart financial strategy that benefits their shareholders. The main goal wasn't just to save on taxes, it was always about getting the best possible returns for shareholders. Apple has spent hundreds of billions buying back its own shares, making it one of the biggest capital return programs ever. When a company buys back shares, the total number of shares decreases, which usually means earnings per share go up, and shareholders end up owning a bigger piece of the company. Borrowing money at low interest rates made sense for Apple because it allowed them to keep their cash flexible and avoid extra tax costs. This strategy often made debt issuance more economically attractive. For shareholders, this approach meant potentially higher returns without Apple having to sell off valuable assets or reserves. Even though most business owners won't manage sums close to Apple's $160 billion, the fundamental financial principles they use are relevant regardless of business size. First, cash isn't always the cheapest funding option. When external financing costs are low, holding onto cash can free you up to invest in opportunities with higher returns. Second, how a business balances debt and equity impacts its value, flexibility, risk, and ultimately the returns to shareholders. Third, tax planning isn't just about cutting costs. It can actually increase the enterprise's overall value when done thoughtfully. Lastly, having strong liquidity offers strategic freedom, allowing companies to acquire competitors, invest during downturns, speed up innovation, and negotiate deals from a position of strength. These lessons are practical and can guide decisions for businesses big and small. Microsoft has traditionally kept large cash reserves while also tapping into debt markets because its strong credit ratings allow it to borrow at low cost. Alphabet or Google similarly holds significant cash and investments, even though it can easily access debt financing. The reason for this is that they both value having financial flexibility and options for strategic decisions in the future. Much like Apple, these companies don't just view their balance sheets as static assets, but as active tools to support their business strategies. This approach shows how large tech firms manage their finances thoughtfully to balance liquidity with growth opportunities. Warren Buffett is well known for holding large cash reserves, even when there are attractive investment opportunities available. While Apple's approach focuses on tax benefits and financial engineering, Berkshire Hathaway's strategy is different. Buffett values the flexibility that comes with having cash on hand and the protection it offers against downside risks. This means he sees liquidity itself as a critical asset. What ties these examples together is the broader principle that sophisticated financial management isn't just about accumulating cash, but rather about making smart decisions on how to use capital effectively. This shared idea highlights the importance of balancing opportunity and risk through careful capital allocation. Apple's borrowing strategy offers several key advantages. First, by borrowing at low interest rates, Apple reduces its overall cost of capital, which can be cheaper than dipping into some of its cash reserves. This approach also allows Apple to enhance shareholder returns. When the company uses debt to fund share buybacks, it can increase earnings per share and add long-term value for investors. On the tax side, borrowing helps Apple avoid unnecessary tax liabilities, preserving more wealth for shareholders. Keeping large cash reserves on hand gives Apple greater financial flexibility, allowing it to navigate uncertain market conditions and seize strategic opportunities. Finally, successfully accessing debt markets at attractive rates sends a strong message of financial strength and confidence to investors, reinforcing Apple's solid market position. Even though borrowing at low interest rates can be beneficial, it still creates ongoing obligations because the interest must be paid regardless of other factors. Taking on more debt increases financial risk, especially if the economy slows down or faces challenges. Changes in tax laws or regulations can also impact the effectiveness of the financing strategy, potentially altering its benefits. The strategy relies on favorable borrowing costs, so if market rates rise, this approach becomes less attractive. Finally, some people may mistakenly view issuing debt as a sign of financial trouble, when in reality, it can be a strategic decision to maximize returns. These risks and disadvantages are important to consider alongside the advantages. The US Tax Cuts and Jobs Act changed how companies think about offshore cash and bringing profits back to the US. Because of that, some of the reasons Apple originally borrowed money have shifted. However, the core idea remains the same. Smart companies always look at whether it makes more sense to use cash, take on debt, or issue new equity to fund their operations. Apple still carefully manages its balance sheet with a focus on maximizing shareholder value, not just paying off debt for the sake of it. This ongoing approach shows how financial strategy evolves but stays grounded in sound principles. Apple's choice to borrow money, despite having one of the largest cash reserves ever seen in the corporate world, may seem puzzling at first. However, once you understand the financial logic behind it, the reasons become clear. The debt they issued wasn't to cover a lack of cash, but was a strategic move focused on making their capital work more efficiently, optimizing tax liabilities, managing liquidity, and ultimately creating more value for shareholders. Effective financial management isn't about simply holding on to the most cash, but about using that capital in the best possible way. The company's financial strength comes from how well management deploys every dollar, pound, or euro, rather than how much cash is just sitting on the balance sheet. Apple's borrowing strategy is a prime example of smart capital allocation, turning financial management into a competitive edge. This approach showcases how thoughtful financial decisions can enhance a company's overall position in the market. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.